Welcome to Talk ETFs, ETF.com's weekly video series. I'm Sumit Roy, Senior Analyst at ETF.com. Today, I'm joined by Arthur Laffer Jr., who's the President and Senior Portfolio Manager at Laffer Tengler Investments, an asset management firm providing investment advisory solutions to institutional and high net worth clients. Arthur, welcome to the show.
Thank you for having me.
So Arthur, after the last Fed rate decision, the Fed indicated that the fight against inflation isn't over and that rates may need to rise more. What's your take on the situation?
The thing that shocked me the most was not that they're potentially going to have two more hikes the rest of the year. I think I could have looked at the numbers and made the case for the Fed one way or another to do either a couple more hikes or to stop. It really depends on what you think is going to happen. So when there's a lot of guesswork involved, you have a lot of options. But the surprising thing was, if you think you've got at least two more hikes coming, why would you pause? Because that clearly signals that you think inflation's not out of the way. It's not behind us yet. So if that's the case, why are they pausing? You should get the hikes out of the way as fast as possible to get the response of helping bring inflation down.
It was certainly an unusual interest rate decision, but the stock market seemed to brush it off and it continued to rally. The S&P 500 is up well over 20% from its October lows, putting it into bull market territory. Given where interest rates are going and given that corporate profits are still falling, has the resiliency of the stock market surprised you?
Yes and no. I think the market's been resilient for a couple reasons. One, everybody was screaming a recession. So the recession hasn't happened. In fact, now it really is questionable whether we're going to have, it may feel like one after the high growth we've had over the last couple of years, but since post-pandemic, but it's clear that the recession never materialized. The economy has slowed down, but it's still not negative. So equity market likes that. Usually it would say, I'm going to price in a recession. I think it started to price one in, and then when it didn't happen, didn't materialize, equities have continued to run. And you've had a different change in leadership. But you look at the yield curve, I mean, it's inverted, which everybody says historically would have been an indication of a recession coming up. That's what we're pricing in. But obviously that's not the case this time, or it's going to be very delayed, which again, makes it's not the case. So something's out of whack here. Either I think it's the bond market that's out of whack, not the equity market, really.
And the Treasury yield curve has been inverted for a long time now, giving that recession signal, yet the economy continues to be very strong. What are your clients asking you today? Are they worried about the economy, and what are you telling them?
I think most of the fear coming from clients is they look at any news source that they have, and it's, the sky is falling. And it's the sky is falling. Either stocks are going to come crashing down, the economy is going to go into recession. Bonds did horribly last year. Middle of the year was okay, and then after June, July, August, things kind of rolled over. People are just concerned. They're concerned about what's going on in politics, policy. It's just there's no clear message. And then when they hear messages, they seem to fall short as expectations. For example, the recession thing. I think you tell people that things are bad and you say the recession's coming, most people believe when they hear it enough times. It's like a very bearish and very negative.
It sure seems like a lot of people have missed this rally because they focused a little too much on those negative headlines. So Arthur, you take an active approach to managing investments. How are you adjusting your portfolios based on your current outlook?
A lot of it's looking at the leaders. So on the equity side, we're trying to pick high quality companies that have strong balance sheets. Either they're at the head of the pack. They also have products that are attractive in kind of any environment. We tend to, as a firm, have more of a value tilt to all of our products. Even our growth products are more GARPy. On the kind of non-traditional equity side, we have convertible security products that, again, are much more value-oriented. So looking for cheapness, high-quality companies, good balance sheets. On the ETF side, it's kind of interesting. I moved duration very short. You're getting paid to be short right now, and moved to high quality. I thought the recession was a very good, distinct possibility, so I moved my credit up into the higher quality spectrum. I probably got out of high a little bit too early in retrospect, but that you don't win them all. But you get paid so much right now to be on the short end of the curve. And I think really going forward, a lot of the risk is on the long maturity, the longer duration part of the curve, like 7 and out. I think that's where your risk is. I think there's a risk here that rates actually go higher, not on the short end necessarily, but on the long end.
You have a long history with ETFs. How do you use ETFs in your practice?
Historically, it was always passive products. That's all that was really available. The neat things about is the maturation of this business. Before, when I got in, I think you could buy some global ETFs, which were the WEBs originally, the World Equity Basket Securities, and then you could have bought SPY. And for the most part, that was really it, other than closed-end funds, right? Now, the great thing is there's so many diverse products that have gotten more and more efficient, and hopefully, in some cases, a lot cheaper, that you have a lot of choices. So the great thing is now, like a fixed income product, you can play maturities, you can play duration, you can play hedged interest rate products. I mean, the product availability of things to build out an active portfolio using ETFs and getting liquidity is just fantastic. I mean, this is the best. I mean, it's like every year it got better and better and better until now. It's just been an explosion of product offerings that are actually getting smarter and smarter. Even the active stuff, you've got kind of the passive, you've got this kind of middle ground, kind of active stuff that's quasi-active, and then you've got real active managers. And as long as you know how to fit them into an active strategy, it's fantastic.
Well, we're going to have to leave it there. It's been an absolute pleasure. Arthur, thanks so much for your time.
Thank you very much.